Hey, everyone, and welcome back to the Profitable Mindset Podcast. Day trading, it's something that I think we all have to kind of grapple with and try to understand better.
Absolutely. And, it can be really alluring, right? All those images of fast cars and big houses, but that's not really the whole picture.
Yeah, it's really important for us to kind of separate fact from fiction today.
Couldn't agree more. And, one of the biggest things that we have to debunk right out of the gate is this idea that you can just get rich quick.
You see it everywhere, right? Like all over social media, people promising these insane returns. And
it plays on that desire for instant gratification we all have.
like, what's the truth here?
The truth is that it takes years of dedicated effort, a deep understanding of the markets.
Right. It's not just something you can pick up overnight.
Exactly.
It's more like, I was thinking about this the other day. It's like comparing someone who just took a weekend cooking class to like a world-renowned chef.
That's a great analogy.
Yeah.
Because they both can prepare a meal, right? But the chef's years of experience and their honed skills and their palate, that makes a world of difference.
Yeah. So to really illustrate this, let's look at two contrasting case studies. We've got James, who embodies that get-rich, quick mindset.
Yeah.
Small account, high leverage, chasing every hot tip he sees, basically gambling.
Right. And then we have Sophia, who takes a more professional approach, starts with education, understands risk management, practices in a demo account.
It's like the tortoise and the hare.
It really is.
Yeah.
James might see some initial wins, but without a solid foundation, they'll be short-lived.
Exactly. And this brings us to another big misconception, the myth that you can win every single trade.
Yeah, the perfect trading system, if you will.
Right.
Always winning.
And it's tempting to believe. Right. But that just doesn't exist.
Even for the most legendary investors. I mean, think about Warren Buffett.
Oh, yeah, of course he's considered one of the greatest of all time. But
he's also very open about the fact that he's made mistakes.
Yeah, and that he's taken losses.
Yeah, because the market is unpredictable.
Yeah, that makes a lot of sense.
So the goal isn't to completely eliminate losses. It's more about managing them.
And we'll be discussing risk management later in much more detail. But for now, I think it's time to move on to another big myth, the lone wolf trader.
Right. That image of someone just, hunched over their computer screen in a dark room, making split-second decisions.
Just relying on their gut.
Which, it makes for a compelling story, but in reality, instinct alone is not going to get you very far.
It's like trying to navigate a complex maze without a map. You're going to get lost.
Exactly. And trading without a defined strategy.
Right.
That's essentially gambling.
It's not just about having a strategy, though, right? It's about having a strategy that works for you.
Yeah, one that's tailored to you as an individual, your risk tolerance and your goals.
Which brings us to another myth, blindly following trading gurus.
Oh, yes.
You see them everywhere, too, right?
Yeah.
Those self-proclaimed experts promising guaranteed profits.
Yeah, and they prey on that desire that we were talking about earlier for a shortcut.
But here's the thing. Blindly following someone else's strategy rarely works.
That's because trading is not a one-size-fits-all endeavor.
Everyone's different.
Exactly. You need to develop your own approach, your own understanding of the markets, and your own risk management style.
So instead of falling for the hype, focus on understanding those principles behind the different trading approaches.
Exactly. Learn how to analyze the markets yourself.
So I think it's time to move on to another myth, the idea that you can scale a small account into a fortune overnight.
And this is a very dangerous misconception that can lead to some reckless behavior.
Yeah, it's tempting to think, right? If I can just double my account this month, I can do it again next month, and then I'll be set.
But that often results in taking on too much risk.
Yeah, and when you're dealing with a small account, there's very little room for error.
That's right. A few bad trades can really set you back.
So what's a better way to go about this?
Prioritizing risk management.
Makes sense.
And focusing on your skills. Finding a trading strategy that works for you and sticking to your plan.
Okay, so next up, let's talk about the myth that indicators are everything.
Ah, yes. Those indicators and oscillators and moving averages.
It can be very fascinating when you're starting out.
They can make you feel like you have some sense of control.
Right.
But the truth is, they're just tools, not crystal balls.
Yeah.
And they can be incredibly valuable when you're using them correctly, but you can't over-rely on them.
Why is that?
Well, they're lagging indicators. So by the time they're generating a signal, the opportunity might have already passed.
They're also prone to generating those false signals.
Especially in those volatile markets.
And if you put too many on your charts,
then you just end up with a confusing mess.
So how can we use them effectively?
By understanding the limitations of each indicator.
What does it measure? How does it work?
Right. And most importantly, You use them to confirm your analysis, not to make the trades for you.
So you're saying price action should be our primary focus. All right, so next up, let's discuss this myth that high leverage equals high rewards.
Leverage can be a really powerful tool, but only when used responsibly.
Yeah, I was thinking about this earlier. It's like driving a high-performance sports car. It's thrilling, but if you don't know how to handle it,
You're going to crash.
yeah, exactly.
Because leverage amplifies both gains and losses.
So how can we approach leverage responsibly?
By understanding how it works.
What is margin? What are the leverage ratios?
Right, and then start small.
If you're new, it start with a low leverage ratio like 5-to-1 or 10-to-1.
As you gain experience, you can gradually increase, but always with caution.
And always use a stop-loss order.
I couldn't agree more. That is your safety net.
So I think we've done a good job of debunking some of the biggest myths surrounding day trading. Now it's time to shift gears and talk about the realities.
Yes, let's dive into what it really takes to be successful, starting with the learning curve, which can be longer and steeper than most people expect.
You know, it's like those reality TV cooking shows where you see those contestants whipping up these gourmet dishes in minutes, but you don't see the years of practice behind it.
Exactly. Day trading is just like any craft. It takes a lot of dedication and patience.
Right, and a willingness to learn.
Yeah, and one of the biggest pitfalls that I see with new traders is that they can get overconfident.
Oh yeah, they have a few early wins, and then they think they've got it all figured out.
But then the market has a way of humbling you.
And that's when those inevitable losses come.
Exactly.
Another mistake that I see is people jumping between different strategies way too quickly.
That's right. They get frustrated when the first approach doesn't work and then they're off to the next shiny thing.
Always looking for that magic formula.
But the truth is, every trading strategy has its pros and cons.
So how do you even know where to start?
By finding a trading style that actually suits your personality and your lifestyle.
So are you a scalper? Are you a day trader? A swing trader?
Each style has its own approach, right? It's like choosing a sport. You wouldn't expect a marathon runner to be great at sprinting.
Makes sense.
Yeah.
So no matter what style you choose, though, you have to accept that day trading is an emotional roller coaster.
That's right.
I think this is something a lot of people don't realize when they get started. They come in thinking it's all logic and numbers.
But trading is very psychological. You're always dealing with risk, uncertainty, and potential gains and losses.
I know so many people who have felt that rush of adrenaline when a trade goes in their favor, but then they get greedy.
Right. And they hold on too long.
Only for it to reverse and wipe out all of their games.
Exactly. Or you experience that frustration of a loss and then
You start chasing the market.
and end up digging yourself a bigger hole.
So how do you deal with all of this?
By developing strategies for managing those emotions.
You need to recognize those triggers.
And stay disciplined even when the market is testing your nerves.
Yeah, it's easier said than done, but it is possible. Okay, so moving on. Let's not forget about another reality of day trading. It's not free.
There are costs involved.
Yeah, commissions, spreads, fees, it can add up.
Especially if you're trading frequently.
So you really have to be mindful of these costs.
Absolutely. Make sure they're factored into your trading plan.
Okay, so next up, let's talk about the fact that you're not just trading against the market.
Yeah, you're trading against institutions and algorithms and professional traders
Who have way more resources and experience than we do.
It's like going up against a professional athlete when you're just starting out.
So does that mean retail traders can't succeed?
Not necessarily, but you do need to be realistic about the challenges.
And find those areas where retail traders have the advantage.
Exactly. Agility, flexibility, and the ability to go unnoticed.
So don't try to outmuscle the institutions. Find those niche opportunities.
That's right. And that brings us to the most important reality: risk management.
I knew you were going to say that.
It's the foundation of success. You can have the best strategy in the world.
But if you don't manage your risk, you're going to blow up your account.
So it's like building a skyscraper without a solid foundation.
It might look impressive for a while, but eventually it's all going to come crashing down.
Risk management is about protecting our capital.
Preserving your profits and staying in the game for the long run. So what are some of those core principles that every trader should understand?
First, define your risk per trade.
So decide how much you're willing to lose on any single trade before you even enter it.
Exactly. Most pros recommend risking no more than 1 to 2%.
That might seem small to some people, especially when you're just starting out with a small account.
But it's a marathon, not a sprint.
Makes sense.
Yeah.
You're protecting your capital from those big losing streaks.
That's right. And then there's the stop-loss order.
Our safety net.
Your last line of defense.
So if a trade goes against us,
The stop loss automatically exits the trade for us.
limiting our losses.
Exactly.
But where do you even place that stop loss?
Well, strategically, you don't want it too tight or too loose.
Right. You got to find that sweet spot.
That balance between giving the trade some space to breathe, but also protecting yourself.
Are there any tools or techniques that can help with this?
You can use technical indicators like Bollinger Bands or average true range.
Okay, so we're not just randomly picking a number.
No, you're using analysis and judgment.
So next up, we have to maintain a positive risk-reward ratio.
That's right.
What does that even mean, though?
It means that your potential reward should be larger than your potential loss on any given trade.
So like 2 to 1 or 3 to 1.
Something like that.
So even if you only win half of your trades, you can still be profitable.
As long as your winners are bigger than your losers.
That's a great way to think about it.
And then there's diversification.
I've always heard that's important for investors.
It's important for traders too.
How so?
By spreading your risk across different assets, markets, and even strategies.
So if one market is doing poorly, you're not completely reliant on that.
Exactly.
So it's all about managing that risk.
That's right.
Okay, so I think it's clear that risk management is more than just protecting our capital.
It's about protecting our mindset too.
Absolutely, because trading can be so emotional.
It can.
The fear of losing, the urge to revenge trade, all of that can really mess with your head.
It can lead to impulsive decisions.
So how do we overcome this? How do we build that resilience?
Well, one way is to develop that sense of confidence through control.
What does that mean?
By having a solid risk management plan in place, you're essentially freeing yourself from a lot of that fear and anxiety.
It's like that safety net analogy you used earlier.
Exactly.
If you know you're not going to fall too hard, you can perform better.
That's right. You can approach the market with a calm and disciplined mindset.
So what are some of those practical tools that we can use to enhance our risk management?
A position size calculator can be really helpful.
Okay, what's that?
It helps you to determine the right size for your trades based on your account balance and your risk tolerance.
That sounds useful.
There's also risk management software.
What does that do?
It tracks your risk exposure in real time and can even alert you if you're exceeding your limits.
So it's like a safety net for our safety net.
That's one way to think about it.
You can also use visual tools like risk graphs.
Yeah, which can help you to understand the potential profit and loss for different scenarios.
I've heard of those.
And many platforms offer automated risk management features like trailing stop loss orders.
So you don't even have to manage everything manually.
Exactly.
Technology can be very helpful.
It can.
Okay, so now that we understand the importance of risk management, let's talk about how we can create a successful approach.
That starts with developing a well-defined trading strategy.
You know, I think a lot of traders struggle with this.
It's one of the most common challenges.
Yeah, they jump from one indicator to the next, always chasing the latest hot tip.
Or relying solely on gut feeling.
Yeah, but you need structure.
A strategy is your roadmap. It's your game plan.
So where do we even begin?
By defining your objectives. What are your goals? What is your risk tolerance?
Like, are you trying to make a quick buck, or are you in it for the long haul?
Right, and once you've answered those questions, then you can start crafting a strategy that aligns with your needs.
It's like building a house. You need a blueprint before you start.
Exactly, and then you need to choose a trading style that suits you.
Scalping, day trading, swing trading.
You have to find the one that fits your personality and your lifestyle.
And then you have to understand the market you're trading.
That's right. Every market has its own characteristic.
Volatility, liquidity, all of that.
And once you understand that, then you can start putting together the core components of your strategy.
Like what?
Are you going to rely on technical analysis? Fundamental analysis?
Or a combination of both.
It's really up to you to figure out what works best.
So we have a lot of flexibility here.
Yeah, there's no one right way to do it.
You have to find what resonates with you.
Exactly.
And of course, no strategy is complete without a solid risk management plan.
Which we already discussed.
Right. Defining our risk per trade, using stop losses, all of that good stuff.
Yeah, that's the foundation.
And as you're building your strategy, remember to keep it simple.
Yeah, don't overcomplicate things.
The best strategies are usually the simplest.
That's right.
It's like writing a song. Sometimes the most powerful songs are the ones with the clearest melodies.
Exactly.
Okay, so once we've got our strategy, how do we test it?
We backtest it.
What is backtesting again?
It's when you apply your strategy to historical data.
So we can see how it would performed in the past.
That's right.
Like we're going back in time.
And there are two main approaches to backtesting, manual and automated.
What's the difference?
Manual backtesting is when you go through those charts yourself.
Okay. So it's more time consuming.
It is, but it forces you to really engage with your strategy.
I can see how that would be helpful.
Automated backtesting uses software to do the heavy lifting.
So it's much faster.
It is.
But regardless of the approach that we use, we need to keep an eye on those key performance indicators.
Win rate, risk-reward ratio, max drawdown.
All of that.
But remember, past performance is not necessarily indicative of future results.
That's an important disclaimer.
It is.
Okay, so once we've backtested it, what's next?
Forward testing,
Right.
which is when you take your backtested strategy and apply it to live market conditions, but
But in a demo account.
exactly, so you're not risking real money.
So it's like taking our strategy for a test drive.
That's a great way to put it.
Okay, once we've done all of that, we can finally move into live trading with real money.
But even then, proceed with caution.
Don't jump in all at once.
Start small.
Get a feel for it.
And as you gain more experience and confidence, you can gradually increase your account size.
Okay, that makes sense. Now let's move on to another important topic.
Journaling.
Your trading journal is an essential tool.
It's more than just a log of your trades, though, right?
It's a mirror reflecting your growth as a trader.
It helps you to understand your strengths and weaknesses.
Your biases.
And those patterns that keep emerging.
Exactly.
You can identify those self-sabotaging behaviors and start to correct them.
So what should we be including in our journals?
Everything. The date and time of the trade, the instrument, the entry price, the exit price, the profit or loss, all of that.
But also the why behind those decisions.
Exactly.
And our emotional state before, during, and after each trade.
Because that's where a lot of those bad decisions come from.
Yeah, our emotions can get in the way.
They can.
And don't forget about the lessons learned,
Every trade has a lesson.
whether it's a win or a loss.
That's right.
So how do we even keep a journal?
You can do it manually with pen and paper.
Ah, the old-fashioned way.
Or you can use a digital platform.
So many options.
The important thing is to find a method that works for you and then stick with it.
Make it a habit.
Exactly.
Okay, so let's talk about something that might seem a little bit counterintuitive here.
What's that?
Looking beyond day trading.
I think this is very important.
It might seem strange to be talking about this on a podcast about day trading.
It might, but the truth is day trading is just one piece of the financial puzzle.
It's not the whole picture.
Relying solely on day trading can be stressful and unsustainable.
So we need to diversify
Exactly. Build a more solid foundation.
and create multiple streams of income.
That's right.
So how do we do that?
Long-term investments are a great place to start.
Stocks, bonds, real estate, things like that.
Exactly.
These assets can appreciate in value over time.
And provide you with more stability.
So we're not just chasing those short-term gains.
Right.
And then there's passive income.
Which can be very powerful.
How do we even create passive income?
You can start an online business, build a following on social media, invest in dividend-paying stocks or rental properties.
So many options.
And the best part is that it frees you from that constant pressure of needing to generate income from your day trading.
So you can trade with a clear mind.
Exactly.
And then for those with a higher risk tolerance, there's alternative investments.
Like crypto, precious metals, and private equity.
These can offer some great diversification,
That's right.
but they're also riskier.
So do your research.
Okay, and no matter what our financial strategy looks like, we need an emergency fund.
That's right. That's right. It's like that financial cushion just in case something unexpected happens.
So we're not forced to make any rash decisions.
Exactly. And as you build this diversified strategy, you have to think about how day trading fits into it.
Right, it shouldn't be the only thing we're focused on.
It should just be one component of a larger plan.
It's like having a balanced diet.
Yeah.
You wouldn't want to eat only pizza, right? You need variety.
That's a great analogy. Day trading can be a good way to generate income, but you need those other sources of wealth creation for balance.
So long-term investments, passive income streams, and that emergency fund.
Exactly. And as you get better at day trading and you start seeing those profits,
You can reinvest some of that into your other investments.
right, and gradually accelerate that wealth building journey.
Using those profits from one venture to fuel the growth of another.
Exactly.
I know this can be a tough shift for some traders.
It can.
They get so focused on day trading that it's hard to see the bigger picture,
And there's so much hype around it too.
promising those quick riches.
So we have to reframe our thinking.
Right, instead of seeing these other strategies as distractions,
We need to see them as complements
because they can actually reduce our stress and enhance our chances of success,
by providing stability.
and allowing us to approach the markets with a clearer mind.
That's right. And one of the biggest obstacles that I see is emotional resistance.
Oh yeah, we get so attached to those short-term gains,
It's hard to let go of that.
especially that adrenaline rush.
Yeah. But we have to remember that the ultimate goal is financial freedom.
And that's about more than just making money, right?
It's about having choices, having options, and living life on your own terms.
So how do we even get started with all of this?
Start with a simple assessment of your current financial situation. What's your income, your expenses, your savings, your debts?
Like a financial checkup.
Exactly. And once you have a clear picture, then you can start setting goals.
And exploring those different investment options.
Right. You don't have to make big changes all at once.
Just start small and be consistent.
And there are so many resources available to help you.
Books, courses, advisors.
Find the information and support that you need.
Okay, so let's talk about that fear factor that comes with investing.
It can be intimidating, I know.
Especially when you're used to the world of day trading.
But remember, knowledge is power.
So the more you learn,
The more confident you'll become.
and the more comfortable you'll feel making those decisions.
That's right.
Okay, so what about the people who say they don't have enough money to invest?
You don't need a ton of money to get started.
Yeah, that's a common misconception.
Start small, invest what you can afford.
Consistency is key.
Exactly. And as you make more money from day trading, you can always reinvest some of those profits.
Creating that virtuous cycle.
That's right.
And I think it's important to remember that the ultimate goal of all of this is to achieve financial freedom.
Yeah, absolutely.
And that's about more than just having money, right?
It's about having choices
Yeah, it's about aligning our financial resources with our values and our passions.
and creating a life of abundance.
So our finances support our dreams instead of limiting them.
Well said.
Okay, so as we wrap up today's episode,
Yeah.
I want to leave our listeners with one final piece of advice.
Okay. I'm listening.
Focus on self-awareness.
That's so important.
Trading is not just about the technicals. It's about understanding yourself, your strengths, your weaknesses, your biases.
It's about knowing what makes you tick.
Exactly. And that can help you to make better decisions.
Absolutely.
So thank you for joining us today on the Profitable Mindset Podcast.
It was great being here.
We'll be back next week with another episode.
See you then.
Until then, happy trading. And remember, the most profitable investment you can make is in yourself.